Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
All right, guys, welcome back to the show. I'm your host, Brett McCollum, and I'm here today with Big Mike Zlotnik. And today we're going to talk about all things syndications and funds and how the active real estate investor can benefit from that. Guys, at Investor Fuel, we're here to help you with all you real estate investors, service providers, and just real estate entrepreneurs in general to 5X your businesses and allow you to build the business you've always wanted and live the life you've always dreamed of. Without further ado, Mike, how are you, man?
Hey, Brett. Thanks for having me.
Man, I'm really excited about our show today, Mike. You got so much to teach us and so much to talk about. You've been in the business a long time, and your reputation precedes you, man. So I'm honored and humbled that you're here with us today.
You're too kind. I appreciate the opportunity to be here.
No, I love it, man. So, Mike, do me a favor. I mean, obviously, you and I have talked, off camera a little bit here and off the recording. Tell people a little bit about you, like who's Mike, how'd you get into real estate, that sort of thing.
Sure. Live in Brooklyn, New York. My lovely family. I have 4 kids. I actually call 4 monkeys and a cat. I have a real cat, and married for many years. Got into real estate originally. Actually, I like to say this. There's a James Bond movie, From Russia with Love. I didn't grow up in Russia. I grew up in Moldova, but it was part of the former Soviet Union.
Okay.
Now it's not very popular, as you know, with Russia invading Ukraine, unfortunately. But my hope is that the war does come to an end soon. But I come from Moldova. I came in '89 as a political refugee from the former USSR. I'm a U.S. citizen, U.S. patriot now. That's the short version of it. I started in real estate in 2000, buying passively. So I was a really passive investor while maintaining technology executive career. So I had a technology executive career for almost 15 years. In 2009, I went real estate full time. And originally, I was just buying passively in New York City. It's not easy to buy a lot here. It's expensive.
Yeah.
But I did this just for 9 years, just to realize this is my passion. Real estate is a lot of fun. For your audience, obviously, a lot of guys and girls, professional, they love it. And I find it, if you do well in real estate, especially when you invest for long term,
right, you
do your work once, and then the assets can work for you for years if you buy right. So that's sort of this passive investing, is as much as active is music to a lot of people years. Passive can actually be a great story too. I did it for 9 years before going active, and I can tell you both of them works. And sometimes you go active, and then you decide to take it easy, retire or semi-retire. Then you go a little more passive. So it's a journey. It's an evolving journey.
Yeah, I mean, you've been, like I said, 25-ish years now. You've been on the journey, right? What happened? So 2009, you decided to take that full-time leap. Was there a specific thing that happened that was like, yeah, that was the marker of that said, I'm in full time, or kind of what happened at that point?
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
It was purely timing of my technology career. I was wrapping up a technology gig. I had a successful career, but I was tired and burned out. So for me, the switch was natural. Having a successful career in technology, desiring to really get more time freedom and do what I want to do and work from home instead of working for corporate America.
Right.
So at that point of time, it was fairly easy to switch. So it didn't happen because 2008 crisis took place and I wanted to jump in 2009. It kind of happened incidental, and we started funding short sale flips. The market kind of picked up. So what we did is kind of our original tempo funding was funding. We provided transactional funding or flash funding. It was kind of crazy. Jason Medley from the CG Mastermind, he had a visionary, and he founded CG and he moved on. And we were #2 transactional funder in the country. We started, and then we did 2009, 10, 11. Then all the transactional funding became more and more difficult. Then we moved into hard money lending. And then over time, morphed the business into, we still do hard money loans. We still like the business. But we moved into a lot of commercial real estate investing, both debt and equity.
Wow, that's really cool. What was, so, I mean, I've been talking a little bit more with some of you guys that are more seasoned. You've been in, the real estate space. What was it like, going from, that 2008 to, let's call it 2015-ish, right? That kind of run when things were just like straight down for a little while. On the lending side, was it anything? Because I know how it is on the operator side, on the active side of things. What is it like on the lending side going through that kind of an environment?
Well, the market was actually good for lending since 2008-9 crisis. You at the bottom of the market. Then, depending on where you are in the country, we continue to finance a lot of deep buys. So, an investor would negotiate short sale, get a property at a steep discount from the bank, REO, etc. And it needed financing. So, as a hard money lender, we were charging, at the peak of the market, we could charge 18% and 5 points. I'm not kidding you.
Yeah.
Then it gradually started to get a little worse. More money came into the market, more competitive. So from a lending perspective, that business was pretty solid, although returns were diminishing a little bit. But again, I'm going back from 2000, let's call it 9, 10, 11, all the way to 15, maybe 16.
Right.
The marketplace got a lot more competitive, so the yields on the hard money loans continued to erode. And that's the time where we decided to really start going into more equity.
Yeah.
But if you picked up on equity in any of those years and you held to anything, pretty much, you've done, as an equity investor, you would have done even better than the lender, because the values continue to appreciate. So as a lender, you got repaid, but as an equity, your equity grew faster than the interest rate on these hard money loans. That's what the market looked like. But it wasn't all overnight. If you held it long enough, then the math really worked out.
Yeah. It sounds like, if I'm understanding you correctly, it sounds like your pivoting has just kind of been, as the market is evolving and changing, you've been pivoting kind of the money, the lending side of your business, the hard money to equity, you're just kind of pivoting with as the market's changing as well. Is that what I'm hearing?
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency. It's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
Yeah, exactly. So what we do day in and day out, we are capital partners. We're the lenders, so capital partners on deals. We're not actively running a lot of these fix and flip projects or buy and hold or commercial deals, multifamily, storage, open air shopping, industrial. We've been very opportunistic, looking first who we can work with. So it's always who before looking at any deal. And once we find these relationships, we've been pivoting, and as we go along, we've looked at where the better opportunities are.
Yeah.
So example, like right now, we know there's a deep value buy opportunities in multifamily as an example. In general, commercial real estate is much more sensitive to the interest rate than residential. Residential has held up in many markets because of limited supply-demand disbalance, right? So interestingly enough, today, we're looking at very deep value buy in multifamily, and we're pivoting back into equity. While the last couple of years has been more of a debt type of a play because the market shifts, and it's not for everyone. For those folks who are looking to stick with their program, all they do is they jack of one trade, and they're a really wonderful jack. There's nothing wrong with that.
Right.
But the problem is the market changes. Sometimes the opportunities dry up. You have to do something else. If you've been doing wholesaling, you can't find the deal, so the spread's too tight. You're taking too much risk, so you have to change and do something else. I've literally spoken with a number of wholesalers who are saying, they've built up a big nest egg. You know what they want to do today? They don't want to wholesale. They want to invest the money, get some passive income, and take less risk because the spreads are tight. And if something goes wrong, they may be stuck with a loss.
Yeah, so you're kind of leading me into so the market's pivoted, or it's pivoting, and you guys are going along with it, almost back to you've been here and done that. You've seen it, you've went through it, you have that experience behind you now. Today, 2025, what's the landscape looking like on your guys' side? So you mentioned back into equity again, is that right?
Yeah, on the commercial front, so I'm very specific. Again, on the residential front, we've seen a lot of appreciated properties that haven't really corrected the last couple of years. On the commercial front, specifically multifamily, you see very significant valuation corrections since the Fed went fast and furious, spiked the rates, and then kept the rates at the elevated level, higher for longer. So this higher for longer has created essentially pressure on a lot of the deals that borrowed either floating rate debt or even borrowed fixed rate debt, and then they're maturity's cliff.
Yep.
Right. So these type of deals are transacting. Some of them, not all. Some of them. There's a small portion of the overall market, but there's a relative to what the value add deals represent overall, not a big portion of the market. Right, a lot of stable core plus stable deals. And those deals are with a long-term debt. They've stayed more or less stable.
Right.
But now, if those deals they mature, the commercial real estate trades on a cap rate, and the cap rates essentially expanded. They grew as interest rates grew. There's a direct relationship between the interest rates and then the cap rates. It varies a little bit. So what we see is discounts today versus the peak of the market in multifamily. You could find a property 25% off versus the peak in 22. When you have 25% discount, you look at the inflation and reconstruction cost. Now it's even more expensive to build, to renovate.
Right.
Versus a couple of years ago. So the consequence is Sunbelt heavily discounted, Midwest less. On a general market basis, you've had a smaller correction, but it comes down to individual opportunities. If you can find a great deep discount, 25% off, with a motivated seller, then why not? This is a much better buy versus you trying to invest in residential. So on the debt side, we still do loans. We still actually like to be a lender. The private credit, by the way, in this environment is still very attractive.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
Private credit being hard money lending. Why the banks really pulled out. So if you financed your business using bank loans, that's great. But today, the banks are doing even less in the space. So private credit, hard money loans continue to be a lucrative business for us. So we do that. But we also provide recovery capital in the form of mezz debt. Essentially, some of the deals that were funded with equity, significant equity investment, but they've run out of liquidity. So if you're equity rich, cash poor, we come in as a lender in the mezz debt position. And if a deal is a brand new acquisition at a deep discounted price, we're happy to be in equity, because the upside in equity today, if you buy it with 25% discount, you have a very significant upside versus a couple of years ago. Your risk reward ratios it's called asymmetric return. The risk profile is fairly low, while the upside potential is fairly high. That's the best way to describe it.
Yeah, that's great. So, Mike, we're talking a lot with active real estate investors, right, on this show, and that's our listener, audience. How, like, most of us are taught, like on the wholesale side, fix and flip side, even the traditional residential buy and hold side, there's a lot of it's very transactional, just boom, boom, volume, and when can I get my next deal? With what you guys do, who would you say is the ideal person that needs to hear what you guys do? Tell me, who do you aim to talk to them? Who would benefit the most from talking with you guys?
Sure. So we actually work with a lot of active guys, and it's kind of crazy. Years ago, we used to loan hard money loans. We just used to fund a lot of fix and flips situations when they needed the capital.
Right.
Transactional funding existing when wholesaling wasn't really a thing, or wasn't. And now you don't need the money. Why do you want to even borrow the money for 2 days to 1 day, right? So that went away. But the hard money lending still continues. So we do a little bit of that work with a few guys who run volume, who happy with the relationship. We don't want to be a commodity lender. It's not us.
Right.
But completely opposite. The last few years, we've gotten a ton of these wonderful wholesalers, fix and flip guys, folks who have built rental portfolios to invest passively into deals that generate heavy depreciation benefits, because most of the guys you're talking about, and girls, are REPs, real estate professionals. All the income they generate is from owning real estate, flipping it, some of them holding for long term. And many qualify as REPs, and they can use depreciation-driven deductions from passive investing to help offset the gains, the taxable gains from the active flips. Of course, consult with your CPA professional. It's not for everyone, but for many folks, it makes a lot of sense. So we've gotten from many veterans of mastermind groups like the Collective Genius, who were writing us checks because they've made it out there. They're very successful. They got their great portfolios, and they actually want to get some tax benefits, and they want to invest in these deep, great deals that have significant upside, but they don't want to be active. So when you can get target return, let's call it, low 20s in this environment, maybe even higher, right? IRR, which is pretty strong return. Now, if you're active, you can generate maybe 30% on your money, flipping maybe 40. I don't even know what the exact ratios, but when you deploy your capital, and you're actively managing and you're making an active profit, maybe you could get a better return on that money, but you're also investing a ton of time.
Right.
Now, if you write a check, get significant tax benefits, depreciation upfront, and then you also stand to make cash flow and a strong return, this is what we are talking to a lot of the guys today. Like literally, these are life conversations. Not to many guys is almost strange. Like, why would I want to invest with somebody else? Well, the same way people buy, AI stocks or they buy crypto. They're investing in something that they're passive. It's the same concept. But if you look at the appreciated stock market, AI stocks or S&P 500 or crypto, they've had a great run last couple of years, right? So folks actually taken. I had an investor, I'm gonna laugh at this. He is a real estate professional, friend of many years. He calls me and said I can retire many times over on crypto, but I'm so heavily concentrated in that. And his conversation is what deals I can invest in with you,
Right.
where I can be passive and diversified. So I talked to him about a deal that we have just literally closed last week. So I'll give you an example. What's a deep value commercial real estate, multifamily real estate, deep value buy looks like today, just so you get an idea. A few years ago, the cap rates of multifamily, let's call them, we're 5.5, 6, 6.5, depending on the market, right? These are capitalization rate of multifamily assets. Today, we bought a property with a cap rate exceeding 9%.
Wow.
And we're borrowing the money at 7%. So we have a positive spread between what you borrow and what you pay,
Right.
over 2%. When you buy it like this, and you have a strong cash flow from day one, and you look at the upside, you could make a lot of money after the value add strategy. Typically renovations. We bought a $79,000 a door with a target sale in 4 to 5 years, $160,000 a door, investing $25,000 a door.
Right.
So just for comparison's sake, can you do the same with a single family asset? Of course you can.
Right.
$79,000 a door, 25 renovation takes us into 104 or something like that, and then you see easy exit. Let's call it around 160,000 a door, and you cash flow on the way, and you have economy of scale because that property is 1,046 doors.
Wow.
Like, the economy of scale is so big that it actually helps the deal to get better bank debt financing, helps execution, etc. It justifies professional management, etc. So some folks do this on 200 doors, some folks do it on 100 doors, or 300 doors. But the opportunity today is in multifamily. If you can buy like this at 9 cap or 8.5 cap, versus I don't know where you could see this. Just for another comparison's sake, 79,000 a door with in-place rents, mid 1100s, right? Just you can kind of compare and contrast. Imagine you buy a house for 79,000. I don't know where you can buy for 79,000, but it's smaller rural area somewhere, not big city, and you get 1,150 per door rent.
Yeah, that'd be huge. That'd be great, wouldn't it?
So that's basically an example of this deal.
Yeah. Let me ask you this, Mike. Let's say I'm the active real estate investor, and I've heard about funds, syndications. You hear about this stuff, but like, how do you know how to pick the right? How do I pick the right Mike? How do I pick the right person to, because you've also heard people kind of, losing all of it. Like, hey, I invested, X amount of money into this syndication, and it got burnt. How do you know how to protect yourself? How do you look for the right ones to invest in? What would you advise that way?
So, for the record, I just want to make sure we're recording this late February 2025, right?
Sure.
Very different environments. The people who wrote checks in 2021, 2022, some of these deals are sitting on thin ice. Some of them, the ice already broke, right? Some will be fine. It's important to understand the market conditions. So some syndicators everybody was a genius when things were going well.
Sure. Yeah.
The market pivoted significantly. Interest rates spiked, and a lot of syndicators, unfortunately, couldn't hold up. And we've seen this rodeo before. But the bottom line is, if you've written a check into a deal that went south, what do you do? there's a wonderful book called Sometimes You Win, Sometimes You Learn. You have to learn from the experience. And learn from the experience means also realize whether it was a mistake to invest, was the operator problem with the market? Is it the recency bias that the market has hurt you so much? Or is this something that an operator did? So part of the process is due diligence on the operators, who you're investing with.
Right.
And there's no easy path here. So we actually are investors too. We write a lot of checks from our funds. We run funds that invest. So we very well understand what an investor thinks when they consider writing a check to us.
Right.
It's the same thinking. Who are you investing with? Are you basically you're picking the jockey, not necessarily the horse. Not you're picking the operator, the sponsor first, and as long as they're good at understanding the market, they're good at execution, they're good at their specialty, whatever the strategy. That's a starting point. Doesn't mean you're going to write them another check, but at least are they good communicator? Do they have high integrity? Number of these reviews are critically important. When we get a new opportunity, we always start with a referral. Is there a referral chain? Without referral chain, it's a little hard. So you start with a referral chain. 2, you try to understand who you're investing with. Know, like, and trust. These are the 3 magic words. You have to establish that first. True. Is this easy? No. So for us, for example, for this year, because we run these funds that invest into diversified strategies, we're looking to add to our portfolio maybe 1, 2, or 3, not 20. A couple of folks we want to continue to invest with, but be programmatic. Deal number 1, deal number 2, deal number 3 over time. Right? So, but that takes picking and choosing who you're investing with, what strategy. So a couple of funds we run. One of the funds, I'll give you examples, Tempo Income Fund. We diversify into multiple income strategies. So we need to identify what strategies can produce actually good income today in equity, not debt. Right. That is pretty easy. That pretty much everything that you loan money in, no matter what asset class, that is income, right? But equity, open air shopping, industrial, deep buy value add multifamily, a lot of these deals demonstrate initial cash flow. So from our perspective, we're looking who we can do business with again and again and again, where they're located, what is their strategy, how they are dealing with the market, how they're finding opportunities. Once you do that due diligence, then you start looking at the pro forma of a specific deal. So if I write a check into this deal, I already know, like, a trust operator. Next question is why this is a great deal. Like, literally, why is this a great deal? Today, you're not looking for a good deal. You're looking for a great deal.
Okay.
So great. There are various ways to look at the great deal, but you could look at the reconstruction cost. There's a cost approach, right? What does it cost to build from scratch? So today, I can buy $79,000 a door. Oh, if I want to rebuild this, it's going to cost me $200,000 a door. Is this a good deal? Yeah. And this is the time, by the way, when people come to me today and they say, I have a great ground up construction project. I look at this and say, okay, for what cost can you build? Well, it's $200,000 a door. Do you have a way to build it for, I'm not saying it's $79,000 a door, for $140,000 a door? I can't get that kind of discount on a ground up. It's impossible. It's like it costs what it costs to build. But on existing assets, you can. So it's one of the huge market dislocations, if you can find them, is to get existing versus new, because new, you might have really great long-term play on this, but you can't build for a steep discount versus what it costs to build.
Right.
That's just impossible physically. So reconstruction cost. 2, what cap rate are you buying at? Right? What kind of initial cash flow can you get? Classically, in multifamily, you had negative spread. People would buy at a cap rate below the cost of money. When the interest rates were very low, people would buy at insanely low cap rates, right? Because the interest rates were low. As interest rates rose, the cap rates started to rise. But many markets still operate where the cap rate on multifamily is trading still below prevailing cost of money. And in that case, you have a negative spread. Can you buy with a positive spread today?
Right.
So the positive spread is creating margin of safety. Then the next thing you need to look at, how how, what's the value add plan, if there's a value add plan. Can you buy, it's almost like this. To buy a dislocated asset at a great price, you need to have a motivated seller, and you need to have something that other people may not see. So the property is on the market. Can you see something other people don't? Or can you get to the property without it being on the market? The same is true in wholesaling, right? If you're trying to avoid, you can't get a deal if the property is being marketed heavily. But if you can get to the seller, make a deal with them, then you can get into a deep buy situation. So again, reconstruction cost, spread between the cap rate and the interest rate. What is the value add? Can you get other benefits like tax heavy depreciation benefits? Can you get tax abatements? Can you get reimbursements from utility company for energy efficient improvements? Also, can you clearly see what are the market rents today versus what are the rents in your community today?
Yeah.
Right. If you give you example, that deal that I mentioned to you called Waverly on the Lake, near Ann Arbor, Michigan, the in-place rents, the average trend is around $11.50 today. But the market has plenty of comps, close proximity, $1,400-1,500. Now, granted, they've gone through some level of already improvements, but you've got to see that. And if you see all that, then the path to get there is easy to understand.
Right.
And then the ultimate question, if you bought this asset today and you just cleaned it up and didn't sell as motivated seller, what price can you actually flip it at? Like a wholesaler flipper, right? So we looked at this deal and we thought we could probably flip it if we wanted to for $115,000, $120,000 a door without doing a lot of work. So you can, if you can get $479 as is, maybe be conservative, call it $110 a door. If you have that margin of safety, then you have a phenomenal deal. That's the bottom line. Same thing, the same thing the wholesalers do on a one property, you can do on a large commercial deal. It's a lot harder to do.
Right.
But if you can get that, if you can believe that you're getting that deep of a discount, then it's a 1,000x versus one door.
Yeah.
Does that make sense?
Truly, yeah. Makes perfect sense. Man, Mike, you unpacked a lot there for everybody to listen to. So, guys, I encourage you to go back and re-listen multiple times because there's a lot to learn from it. And speaking of that, Mike, if people want to reach out to you to maybe they want to learn a little bit more and want to start looking into doing into the fund side of things or in the syndicate, like how could they get a hold of you? How do they look you up? Tell the people how to reach out.
Sure. So fairly straightforward. So bigmikefund.com.
Perfect.
That's the website. And if you misspell it, then you forget D at the end. I promise not to keep it safe. So
yeah, don't forget that. Do not forget that.
But you could forget it. Actually, I do own the other domain. So I was on one of the podcasts like this. I said bigmikefund.com, and they didn't hear the D at the end. It's like, did I hear it correctly? And then within 30 seconds after the end of the call, I ran to the GoDaddy and I grabbed the other site and said, okay, I just want to make sure.
There you go. Okay, perfect.
They don't wind up on the wrong site.
There you go.
But I'm happy to. So most of what we do day in and day out is investing, right? We're capital managers. We manage capital. Folks write us checks into individual deals or funds if they want to diversify, right? As I gave you an example. But also what I do on a limited basis. Folks want to start a fund. If they have interest in using a fund for any of their strategies, I do a little bit of coaching in the space through bigmikecoaching.com of all websites. So if folks need a little help how to set up a fund, I literally had recent conversations with guys who do a lot of it, what you described, wholesale. But the good old rule, flip 5, keep 1.
Right.
Keep 5. At some point, they start building these rental portfolios. And I had a discussion with one of these folks who basically said, well, we do 60 to 80 additional new rentals per year. Based on what we flip, we actually keep 60 to 80. And I want to do a fund that will essentially finance my acquisitions. So that's an opportunity to build a fund for turnkey rentals that buys 60 to 80 per year. It doesn't have to be, if it's too small, fund overhead is too much. But if you do reasonable volume like this, you could set up a fund, you can justify overhead and justify the cost of running a fund. Again, funds, I do this all day in and day out. Understand the space, open-ended, close-ended, lending fund versus equity fund, value-add fund versus its core strategy. So happy to do this. Specialty funds like self-storage, multifamily, or geographically concentrated funds that are just do nothing but New Jersey, for of all places. Happy to chat, happy to help from that perspective. But it's something if folks need it. It's not what I do. I happen to know a lot in the space, and I love a little bit of coaching with the right person. So it has to be two-way street. If somebody reaches out, they need a little help. We chat. If I feel that they are great talent and it's worth my time and I enjoy the experience, then I'll consider. If not, hey, no harm.
Sure. Well, yeah, we'll make sure we put all the information, in the show notes for everybody to look up. But guys, a lot of information. Mike's been doing this a long time. I encourage you again, listen, re-listen, reach out to Mike if you like, and I will catch you guys on the next show. Take care, everybody.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.